When the Fed starts cutting, it's usually because they see things breaking out there. In other words, the system is tipping into into a recession or something that might be worse than a recession. And the fact that, and everybody else sees that too by that point. So the fact that that's happening is a much bigger deal to the markets than, oh, we got a 0.5 point cut in the Fed funds rate. They're looking at mass bankruptcies and, equities imploding and things like that. And that's when the Fed is forced to start cutting. They might think geopolitics is the thing forcing them, but it could be us tipping into recession in 2024. I think by the end of next year, we could see the Fed in full panic mode.
Despite the Federal Reserve's decision to maintain unchanged interest rates within the target range of 5.25% to 5.5%, concerns persist regarding the potential delayed impact of prior rate hikes on the economy. JohnRubino, the founder of DollarCollapse.com, forewarns of possible distress in the financial system, indicating a looming threat to mainstream investors. Federal Reserve Chair Jerome Powell stressed that the task of steering inflation down to the targeted 2% level remains a prolonged process, keeping the decision for the upcoming December meeting open. Powell indicated that rate cuts are not under consideration at this time. Rubino anticipates a scenario where the Federal Reserve might shift into a state of panic by the end of the following year. His sentiments align with Peter Schiff's recent remarks, emphasizing that the current course taken by the Fed may not effectively combat rising price inflation, implying a lack of true economic growth. With Rubino suggesting the insufficiency of the Fed's present policy in averting a potential recession in the coming year, gold prices advanced following the Fed's cessation of interest rate hikes. Join us as we delve into insights shared by JohnRubino in his recent interview with Liberty and Finance. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
Yeah, this is the second straight Fed meeting without a rate increase. And the markets are behaving like they think this is the pause before the capitulation, when the Fed starts cutting rates. In other words, stocks are up. People are buying the long-term bonds really aggressively because they think interest rates have peaked and are going to roll over. And, there's something to be said for that because it's a surprise that interest rates got as high as they did this time because rates peaked. If this is the peak, they peaked at a level that's a little bit higher than where they peaked in 2007, 2008. And normally the way these cycles go and the way, the gold bugs and the sound money guys theory of the system goes, the interest rates peak at a lower level in each succeeding cycle because we're more and more over leveraged as time goes on. So we're less and less able to handle interest rates at a certain level. And so a lower level is all that's needed to start breaking stuff. But this time we got a little higher than the previous peak, which surprised me. I didn't think we could get to the level of 2008 without breaking everything in sight. And things are starting to break. You got big trouble on bank balance sheets. Commercial real estate is imploding in some cases. Consumers are tapped out. If you look at, for instance, the number that the Fed compiles for excess savings, that's all gone. The money we saved during the pandemic is over now. And there's not an obvious pool of money that's left for consumers to spend. Credit card debt is through the roof. Credit card delinquencies through the roof. The student loan payments are starting to kick in. So there are a lot of reasons to think that the economy is rolling over. Oh, and the last quarter's, third quarter GDP number was very hot, 4.9% annual rate. But the projected number by the Fed and other economists is 1% annualized growth in the fourth quarter. So lots of reasons to think the economy is slowing down, lots of justifications for the Fed stopping their tightening. And so that could explain it as far as it goes. But we also got geopolitics out there where the world is just spinning out of control. The Russia-Ukraine war was bad enough and was expensive enough from the point of view of the West. But now we've got the Middle East that is in danger of broadening into not just an Israel-Palestine thing, but Iran, Syria, and the US and Russia and maybe China all being pulled into it. So that's also a good reason for the Fed to stop tightening, because it doesn't want to be extremely tight if a crisis breaks out that affects the global financial system. So, okay, it all makes sense that the Fed is easing. And the question is, stabilizing short-term rates at today's level, is that good enough to save the system from dropping into a recession next year? And I would say, nah, no way. I think rates are already high enough that that monetary tightening continues even if rates stay flat, because all the debt that's out there now that has to be rolled over has got to be rolled over at higher rates. So for a lot of entities out there that are over leveraged, their monetary conditions get tighter and tighter the longer the Fed maintains rates at this level. So I think we'll see that in 2024, where a lot of things that are, kind of behind the headlines on the back burner, but starting to break, actually do break and become headline news going forward.
For years, concerns about the growing national debt, which has now surpassed $33 trillion, remained largely theoretical. However, the annual U.S. budget deficit reached $2 trillion in fiscal 2023, a substantial increase from the previous year's $1.4 trillion deficit. John raises the critical question of whether this mounting debt could potentially trigger a collapse or severe crisis during the next recession, particularly due to the overwhelming leverage within the system and the significant global debt accumulation. According to the Institute of International Finance, IIF, the total debt, encompassing government, household, and business borrowing, has soared to $307 trillion, marking a $10 trillion surge in just the initial 6 months of 2023. Rubino expresses concern that the injection of significant currency, instead of fostering a robust economic rebound through easy money policies, has led to double-digit inflation, resulting in financial hardships for many individuals struggling to cover daily expenses. The current inflation rate in the United States stands at 3.70% as of September, with expectations that it may reach 3.00% by the end of this quarter. Let's get back to the interview.
Basically, since World War II, it's been exactly the way you should play it. Stay invested in equities as much as possible. Ride out the periodic 1 or 2 year long bear markets, and don't panic. And it's worked. So we really can't diss mainstream financial planners. They've been absolutely right. Now, a time will come when the leverage in the system is so overwhelming that buy the dip turns out to be disastrous advice and wipes out retirees and savers and hedge funds. Everybody who buys into that idea gets wiped out. Now, will this be the time? That's the question. Leverage is insanely high right now. We basically doubled the amount of debt in the system since the last recession, since the Great Recession, 2008, 2009, and we're not stopping. We're continuing. The government's running like a $1.7 trillion deficit in the most recent fiscal year. And consumers are taking on more and more debt. Credit cards just hit $1 trillion, and student loan debt keeps rising, as crazy as that sounds. You can look at the auto industry and commercial real estate. Debt has just soared in this cycle. So is the amount of leverage that we've taken on enough to just blow this thing sky high in the next recession? And I thought the last time around was the end of the fiat currency system, because we were too over leveraged and there's no way we recover it from it. But we did recover. So what will happen this time is, we'll get that recession. It'll be scary. The Fed will step in and start easing again. And the question becomes, is there a way to use easy money to rescue a system that has this much bad debt? And my impulse is to say no, again, but you got to take into account that I said that last cycle and I was wrong. But man, we are so indebted. The U.S. government is taking on parabolic amounts of debt now. Japan is at the governmental level more indebted than any other country in human history. Europe, especially the peripheral countries, but also the main countries in the European Union are highly leveraged right now, and they're already right on the verge of recession. And they've got all kinds of other problems too. But wherever you look in the world, you see extreme stress. And China, forget it. They blew up the biggest real estate bubble in human history over the past 15 years. And they're now reaping the consequences of that, and they really don't know what to do about it. So wherever you look in the world, you see extreme financial stress and no obvious savior. The U.S. national debt is now, 120% of GDP, when it was like 70% at the beginning of the last cycle. China is a mess. Japan is wildly over indebted. Europe is not what it used to be. It used to have Germany there as its locomotive. And Germany is now turning into the sick man of Europe because they made so many fundamental mistakes. So it's just not obvious what bails us out next time. We'll try easy money, but it could be that we get something like 2022. In other words, last year, when we pulled ourselves out of a crisis by creating massive amounts of new currency and dumping it into the market. But instead of getting a rocking boom time economy, what we got was double-digit inflation. And a lot of people seeing their lives ruined by not being able to cover day-to-day expenses.
The gold market appears to be treading cautiously as it grapples with the challenge of surpassing the $2,000 an ounce mark. Some analysts suggest that gold prices might require a consolidation phase in the short term before making a sustained push towards its all-time highs. Do you believe that the Federal Reserve's decision to maintain unchanged interest rates has had an impact on gold prices? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.